Good morning, good afternoon, and good evening, friends. Now let's get into the next chapter. As as I was telling in the last class, I'll be saving the depreciation, and I was just going through it. There's separate classes which I have conducted on the accounting from incomplete records. So that is also important for CA students to take the details from the class 11 books, but that is still applicable for the CA students and CMA students as well. I'll consolidate that as well and then put into a single video. So while we go into the next chapter, we are into unit 6 of chapter 6, which talks about account current. This is a very simple chapter, but has got a significance because we have to understand how this account current works. And let's get into the details of it. What is an account current? By the meaning itself, we know that it's a current account, but not with a bank, or rather, it's not mentioned in terms of a current account what is being maintained in the bank, but a running account. It's also called like let me say running account, or where there is a frequent or regular flow of transactions between the parties. And when I say regular flow of transactions, like there can be purchases or sales and cash payment or cash receipts. It happens regularly with the between the parties. Between the parties. So so it is in the form. It is the form of mm, ledger, right? So each account, each um, transaction is unique, and uh, though the though the account is maintained as running account, interest is calculated on the outstanding amounts. Outstanding amounts. How this is being calculated? Let's see. Suppose A is selling to B. Today is 2nd September. A is selling to B on say 15th August. A is sold to B, and the due date for payment is 31st August. So the payment has to be done on 31st August. Now we are on 2nd September. If the payment is not made, then for these 2 days, interest will be calculated on this transaction, right? Suppose A has sold to B, right? So B has paid partial payment. Say the sale A has sold to B for 100 rupees, and B has settled partially 50 rupees on 20th December, on 20th August itself, right? So though the due date is only for the 31st August, B has paid partially 50 rupees on before the due date. So B has to get an interest from A because of earlier settlement. So the entries are maintained in such a way, like from the date of sales or from the date of purchase, from the date of sale, from the due date of sales or due date of purchases, or from the date when the payment has been made, interest is calculated, right? It is very simple. What is the rate of interest and how the interest has to be calculated can be done manually if the flow of transactions are very minimal, or it is very easy to calculate. Otherwise, we can use support of interest tables, which will be provided, and you can calculate the interest based on the interest tables. The normal calculations between two parties can happen basis a normal calculation of interest using your calculator. So let's get into more details about it, like preparation of account current. It can be preparation of account current. One, it can be prepared, as I said, based on interest tables. Interest tables. What is interest tables? We'll look into that, and how. Then it can be prepared by means of products. Means of products. We'll look into this as well. And the third option is by means of products of balances, right? What is the balance? We'll look into this as well. So first one is We'll calculate interest based on preparation of account current based on interest tables if the transaction is between individuals. Like only individual methods, like if only two parties are involved, and how the interest is being calculated. We'll discuss about that in the first one. Like, so according to this method, each transaction, as I said, is treated individually as a ledger. Right? Each transaction is entered in the table. And there should be a standard normal table which contains date of transaction, particulars of transactions, the due date, and what is the amount, and what is the interest percentage, and what is the interest rate. So entered in the table. Like the table will have normal ledger account. Normal ledger account table will have normal ledger account features, and also additional column for interest rate and amount. Interest rate and amount. So the table, like if I prepare it like date. Date means date of transaction, particulars, and due date. Due date when the transaction is amount is due, and what is the amount of transaction, and rate of interest, interest amount. So this table will be prepared for both the debits and credit side, and then the total transactions will be recorded on both the sides. So while hope this is you're able to follow this, right? This is more easy, and then the less complicated one to do. While while this is most easiest to form, interest has to be calculated at the due date and accurately. How the interest will be calculated? Due date of payment should not be included while calculating interest unless otherwise agreed between the parties, right? So this is one of the most common feature of this. Let's get into an illustration now to understand this more easily. So let's get into the illustration now. I just prepared the table for easy reference, and we are in illustration 1. Illustration 1. And so September 16th, please prepare account current for Nath Brothers in respect to the following transactions with Shyam. So heading plays a more important role, as we have to specifically mention whose books it is, who is maintaining this. So in this case, Shyam in account with Nath Brothers, right? Shyam in account with Nath Brothers. Please prepare account current for Nath Brothers in respect to the following transactions with Shyam. The account is to be prepared up to 1st of February. Calculate interest at the rate of 6% per annum. 1 year is equal to 365 days. So we are preparing it as on first interest is up to 1st of February 2016 at the rate of 6% per annum. Okay, that's what is given in the question. Now, first, let's say September 16th. September 16 sales account. Due date is 1st October. 1st October is the due date, and amount is 200. What is the interest? Number of days due is 1st October, and we are on we have to prepare up to 1st of February. So October has got 31 days. Number of days is equal to 31 days in October plus 30 days in November, plus 31 days in December, plus 31 days in January. Total number of days is 123. And the interest amount is 200 into 123 divided by 365 into 6%. Interest amount is 4 rupees and 4 pies. Similarly, next transaction, cash received from Shyam. Okay, Shyam has settled on 1st October. Cash received. And due date is 1st October again. Here is due date is 1st October. Because that is when the payment has come. Amount is 90 rupees. And in number of days is equal to 123 because payment has happened on 1st October, 123. And what is the interest? 90 into 123 divided by 365 into 6%. Oops. $90 is equal to 90 into 123 divided by 365 into 6%. Amount is 1 rupee and 81. 1 rupee and 82 pies is the interest. Students, you might have a question. Why should the interest be calculated for the whole amount? Interest is due only for the amount which is due, like 110 rupees. 200 rupees is the sales and 90 rupees amount received, and 110 rupees is the interest that needs to be calculated. If you calculate in this way also, the same amount will come, same answer will come. Like 404, like let me put this 4.04 minus 1.82. The interest is 200. So let's put 110 rupees and 123 days. 110 rupees and 110 rupees because that is the amount that is due, right? 110 into 123. Let's see what is the interest that's coming in. 2 rupees 24 pies. So why we are putting it separately is it is a running account. Students have to understand it is a running account. So the account current mentions like unless the total amount is settled, there can be like ad hoc payments that will happen where the invoice number will not be mentioned. So the interest has to be calculated for the whole sum. See, why this particular type of account is not prevalent is like because of this ad hoc amount concept that's coming in. If the invoice is mentioned, like this amount is paid against this invoice also, and if the amount is not settled fully, then interest will be calculated because I have paid an advance, I paid a partial amount, so I am entitled for interest on the amount what I have paid. Similarly, since the account is not settled, the interest has to be calculated unless the invoice is mentioned. We'll come to that question in a later chapter, in a later problem. But because this is an ad hoc payment that is received against the due amount, interest is calculated on both the invoice value as well as the payment side. Let's make it more clear with the next one. Like goods purchased from Shyam. Two purchases. Right? Two purchases. It has happened on 1st October. On 1st October, we have purchased, Nath Brothers has purchased some goods from Shyam. And it is due on 1st December. Due date is 1st December. Due date is 1st December. So, what is the total number of days here from 1st December is equal to December 31 days plus January 31 days. Because the amount is due on, we are preparing it on 1st February. We are preparing the account on 1st February. So, what is the date at which we are preparing has to be ignored. Has to be ignored. So, now the interest will be calculated for 62 days. 62 days. Amount is 500. On October 21st, 21st October. Purchases has happened for 500 rupees and the goods have been purchased from Shyam. So the interest is to be calculated for 62 days on 500 rupees at the rate of 6%, which is equal to 5 rupees and 9 pies, 5 rupees and 10 pies. Now, what is the next transaction? Paid to Shyam. Okay, you can see here. 1st November. It is due only on 1st December. Students, you have to follow this now. First, it is due only on 1st December, whereas on 1st November, there's a payment paid to Shyam. Paid to Shyam, and due date it is 1st November. It is paid from 1st November, and the amount paid is 330 rupees. So, though it is due only on 1st December, there's a payment that has happened on 1st November itself, which is a partial amount. It is an ad hoc payment that has happened. So, the interest has to be calculated for how many days? Now it is 30 days in November plus 31 days in December plus 31 days in January. So 92 days the interest has to be calculated, which is 2 rupees 24 pice. Sorry, which is, let's copy the formula, it is 4 rupees and 99 pice. Next one, paid to Shyam 330 rupees again, that is on 1st December. 1st December, again there is another payment that has happened, and which is 1st December, 330 rupees. You can see here the amount purchased is only 500 rupees, whereas Shyam has paid two amount of 330 rupees each. So because the invoice reference nothing has been given and it is a running account, so the interest has to be calculated from the date of payment till the date of interest is calculated. The major flaw in this account, while we don't have to discuss about that now, but to just give a brief why it is being it is never settled. The account is never settled unless the amount becomes due. Even otherwise, interest due and interest has to be calculated even till the last date of the settlement. So it's a very tedious process that needs to be worked out. So now this is 62 days because it is 31 days in December and 31 days in January. So for 62 days, interest is 3 rupees 36 pice. That is the amount that should be paid to Shyam. What is the next one? Goods purchased from Shyam again on December 5. 5th December, purchases from Shyam, and the due date is 1st January. Due date is 1st January, amount is 500, and due date is 1st January means 31 days. 31 days. So the interest is 2 rupees 55 pice. Then next one is goods purchased from Shyam again on December 10. 10th December, purchase from Shyam, due on 1st January again. Due on 1st January again. Amount is 200 rupees. Amount is 200 rupees. Then we have a payment of 600 Shyam. Paid to Shyam on 1st January, 600 rupees. 1st January. 1st January, 600 rupees. Number of days is 31 days. Interest is 3 rupees 5 pice or 6 pice. So goods again on January 9th January to sales. 9th January, which is due on 1st February. Amount is 90 rupees. There is no need to calculate interest here because we are preparing it only on 1st February and it is due only on 1st February. So there is no need to calculate any interest for this transaction. Now, the account currency says the total interest that needs to be paid to Shyam is 15 rupees and the total interest that needs to be received from Shyam is 10 rupees 48 pice. So the net balance is 4 rupees 97 pice. It is the interest balance as on 1st February. The amount to be paid to Shyam because we have received 1550 and we have to pay 1292. The net amount due is 260 rupees and the interest that is due is 4 rupees 97 pice. The students hope this is clear. Like interest has to be calculated on the payment received and on the goods sold or purchases made and the payment to be paid, etc. based on the due date and up to the date. Suppose we are preparing it on say 2nd February, we have to add one more day to this year. For 1st February, it has to be added to this year. And then interest will be calculated accordingly. And also from the due date only the interest has to be calculated. Due date has to be included. Like one notes on this is due date to be included and the date, due date to be included first scenario, and uh, the account preparation date has to be excluded. Preparing it today means 2nd September means 2nd September has to be excluded. If the due date is 1st September, then 1st September has to be included. Interest will be calculated on for 1 day. Okay, hope this is clear. Please go through this. This is much more simple, and we'll go into the next question in the next class. But just have and go through this particular question and come back to me. You can always reach out to me at babupri@rediffmail.com, and you can post your comments onto this video, and I'll give you clarification immediately. Thank you, friends, and have a wonderful learning.